So, welcome guys today. Today we are going to talk about cash flow statement. So we are going to talk about cash flow statement, and we shall focus on the indirect method to do the cash flow statement. So, welcome again. Welcome again. So we wrapped up the other class for the preparation of the final account of the company, and tulimalizia na hii sitting. We did that sitting for August 2024. Question number 4. So today we are going to talk about the cash flow statement, and to be specific, the International Accounting Standard number 7, IS 7. So IS 7. So cash flow statement. So IS 7. So IS 7. This is the cash flow statement. So IS 7, that is the cash flow statement. Cash flow statement IS 7. So IS number 7, or the International Accounting Standard number 7, IS 7. Now we say, so this one is according to the IS 7. So we say the objective. So we say objectives objectives of IS 7 of IS 7 uh, is to require the presentation of the information, the presentation of information to require the presentation of information about the historical changes, about historical changes about the historical changes in cash and cash equivalent. So we say in cash and cash equivalent. So in cash and cash equivalent of an entity by means of cash flow statement, by means of the statement of cash flow. So that's the objective. So the objective of the cash flow statement is to present the information about the historical changes of cash, or the movement of cash. So mostly it is to present the movement of cash in a financial year. So we want to see the movement of cash. So just the movement of cash, nothing else. So in the case where we have the movement of cash, that movement of cash will be reflected in the cash flow statement. So we need to know the cash inflow and cash outflow that occurred within the company. So that's the main objective. So to present the information about the historical changes in cash and cash equivalent in the statement of cash flow, in the statement of cash flow. That is the objective of the IS 7. So that is the objective of IS 7, to record the movement of cash, both inflow and outflow, through the means of the statement of cash flow. And then it classifies cash flow. It classifies cash flows. It classifies cash flows during the period according to the following activities. So let's name the activities. So number 1, we have the operating activities. activities. Number B, we have what we call the investing activity. Investing activities. And number C, talk about financing activities. Financing activities. So the cash flow or the IA7 classifies the cash flows for the period according to the following activities. So we have the three of them: the operating activities, investing activities, and the financing activities. These are the activities which you shall find in the statement of cash flow. Those are the activities which you shall find in the statement of cash flows. Those are the activities which you shall find in the statement of cash flows. We continue. We say all entities, all the entities that prepares financial statement, that prepares financial statements. So all the entities that prepare the financial statements in conformity, or in accordance with the IFRS. So any company which prepares the financial statement in accordance with the IFRS, are required to prepare the statement of cash flows. Are required to prepare the statement of cash flows. The statement of cash flows. So any entity which prepares the financial statement. So any entity which prepares the financial statement in conformity or in accordance with the international financial reporting standards, are required to prepare the statement of cash flows. So such kind of a company is required to prepare the cash. This is means international financial reporting standards. International financial reporting standards. Now, in the foundation level, we cannot talk about this so much. What we said in topic 1 is enough. What we talked about in topic 1 is enough. But for now, we don't need so much of it. We shall do it mostly in intermediate level and in advanced. But for now, what we did in topic 1 is actually enough for the IFRS. Now we are saying that all the entities which prepares the financial statements in accordance or which follows the framework which is governed by the IFRS are required to prepare the statement of cash flows. Are required to prepare the statement of cash flows. That is what I'm trying to say. Okay, move on. Statement of cash flow. So say statement of cash flows. Statement of cash flow analyzes changes. Changes. So statement of cash flows analyzes changes in cash and cash equivalent during the period. In cash and cash equivalent during the period. So that's the main purpose. So the historical changes of cash and cash equivalent. So the cash flow analyzes the changes or the movement of cash and cash equivalent during the period. So it analyzes the movement of cash or the changes. We use the word changes. You can also use the word movement of cash and cash equivalent during the period. And I'm saying during the period, not outside the period which we are. So during the period which we are analyzing actually. So it shows the movement of cash and the cash equivalent. So for example, purchase of non-current assets, there is an outflow. That's a good example. When you have a receipt, in terms of, for example, a good example for a receipt is where we sell an asset also, or where we pay dividends, or where we pay interest. So it analyzes those movement of cash and cash equivalents. So where we have those movement of cash, that one is fine. That one is okay. Now let us see what is this cash and cash equivalent. So we say cash and cash equivalent, cash and cash equivalent comprises of cash on hand, cash on hand, demand deposit, demand deposit, demand deposits, short term, highly liquid investment, highly liquid investment, investment, uh, that are ready, that are ready, that are ready, convertible to known amount of cash, convertible to known amount of cash, known amount of cash, to known amount of cash, and are subjected to a significant amount of risk, to significant insignificant uh, risk, insignificant risk of changes in value, of changes in value. So in short, what constitutes of cash and cash equivalent is the cash on hand. So the cash which the company has already in hand. You can also have the cash at the bank or the demand deposits or any other investment which can be easily converted into cash, or they are highly liquid. So those is what we call them the cash and cash equivalent. And in most cases, our cash and cash equivalent is made up of cash in hand, cash at bank, the short-term investment, and also the bank overdraft. So bank overdraft is also considered as cash and cash equivalent, or also bank overdraft. So remember, bank draft is also included. Bank overdraft is also included. Is also included. So bank overdraft is also included. So bank overdraft is also included. Now, I think we are done with the cash and cash equivalent. We are done with the cash and cash equivalent. So we can say, let's talk about the bank overdraft. Just say something about bank overdraft. Bank overdraft. Bank overdraft, and we can say these are payable on demand. These are payable on demand. These are payable on demand and form integral part and form integral part and form the integral part of the entity cash flows of entity cash flows and form the integral part of the entity cash flows cash flows management full stop. So these are payable in demand, kumaanisha a good example for an overdraft is can come a fuliza, for example, where when you have a fuliza, when you receive amount of money from someone, that amount is deducted immediately. So because of that reason, it forms an integral part of the cash flow of an institution. So if a company has a bank overdraft, it means when they receive cash or the amount through the bank, the amount will be deducted immediately, and therefore they form the integral part of the cash flows management of the company. And therefore, because they are payable on demand or immediately, then it means it forms part of cash and cash equivalent. So demand, sorry, bank overdraft, those are payables. These are payable on demand, or they are paid on demand, and therefore we shall record them in the cash flow statement. Now let us explain these activities. Activities before we come up with the format. So we start with the operating cash flow. Let us explain them. Operating activities. So cash flows from the operating activities. So cash flows, or the cash flow from operating activity, cash flow from operating activity, and we see this. These are the main revenue producing activity. These are the main revenue producing activities. You need to know that one. So when you talk about the operating, it is just the word operating. Operating means that is what we do on a daily basis. So what is our daily basis activity in the company? Is to make sales. So the revenue that we derive from making the sales is what we call the sales from the operating activities, or the cash flow. So these are the main revenue producing activities of the entity. Activities of the entities. Then you can say that are not investing activities. That are not investing activities. I think you're sawa. So any activities that is not investing, and it relates to the revenue production, so to call the operating. Number two, so you can give example. They include. Let's give the example. They include. So they include. We can talk about cash received from customer. Cash received from customers. Cash received from customers. And then cash paid to suppliers, and cash paid to suppliers and employees. Kama salaries and wages, blah blah blah. All those are examples of operating activities. Number two, let us talk about the investing activities. Number two, investing activities. Investing activities, and we say these are the acquisition. These are acquisition and disposal of long-term assets, and disposal of long-term assets. So these are the acquisition and the disposal of long-term assets. Acquisition and disposal of long-term assets. So we say these are the acquisition and disposal of long-term assets, and other investment, and other investment, and other investment, and other investment. So that is all about it. That's all about it. We can tunamalizia ya mwisho. So a good example hapa unasema acquisition of so example which are they are just common. For example, you can say acquisition of non-current assets of PPE, for example, and disposal of a PPE. So tukiuza ama tununue PPE. You can also have a sale of an investment. When you sell a particular investment, also we can include it there because it's an inflow, or when we sell an investment, either way, either we sell or we receive. Then you have the last one, financing activity. financing activities. Financing activities. Now these are the activities which involve equity capital and borrowing of funds. So these are the activities. These are the activities uh, which involve alteration of equity capital, alteration of equity component, and borrowing of long-term borrowing. So these are the activities which involve alteration of the equity component and borrowing component. In borrowing, and borrowing as structure of the entity, and the borrowing structure of the entity of the entity. So we talk about financial activities. So it involves altering the equity component and the long-term loan or the borrowings. So so in most cases, it involves the alteration of the equity component and the borrowing structure of the entity. So it involves those three items. It involves those two items actually, not the three items. So for example, IE, you can talk about IE, issue of shares. We can have issue of shares. We can also have what others. For example, when there's an issue of loan, so that's a component which will affect the financing activities. Also, when we pay interest, payment of interest and dividends and dividends, and also any amount that you receive when it comes to finance. So sometimes you can receive the amount, for example, issue of loan and so on. Now we have two methods of preparing the cash flow statement. Actually, we have two methods. You have the direct method and the indirect method. So direct and indirect method. So direct and the indirect method. We are going to use the indirect method. So we are going to use the indirect method. The direct method is what we should focus on, or we should focus with indirect method. So we want to come up with a format. Let me look for the format. A good format. Yeah. So indirect method. So indirect method. So indirect method. So indirect method. Indirect method. Method. Indirect method. So let us prepare just it's actually just a format for now. So we say cash flow statement. Cash flow statement, or we can just can say let's use the word statement of cash flow, not cash flow statement. Let's use the statement of cash flow. So we say statement of cash flows, statement of cash flow for the year ended, for the year ended, for the year ended, we don't know, so XXX, that's our year end. Then we shall have our currency. In the face of our currencies in Kenya shillings. So tunaanza na cash flow from operating activities. So cash flow from ama ningesongesha kidogo. Cash flow from operating activities. So hii tunaanza nayo cash flow from operating activities. The revenue which is to the main revenue of the company. So we start with the profit before tax. Profit before tax. So like profit before tax. So that one you check in your income statement. So profit before tax, you check it in your income statement. Then you do some adjustment. Adjustment. The first adjustment is depreciation. Depreciation. Now depreciation for tax for purpose of cash flow. Depreciation is an non-cash item. So we are supposed to adjust all the non-cash item. Now depreciation was removed or was required deducted. So depreciation was deducted in the income statement. So if it was added, we add it back. So we add the amount back. So depreciation, we add it back. If you have amortization also, amortization, if there is amortization, it means that the amortization was treated as an expense. It was deducted. Now we add it back. So we are supposed to add it back. Interest expense, if there is. Now interest expense was deducted in our income statement as an expense. Then, because it's an cash item, we add it back. We add it back. Higher. Interest income, stroke investment income. Investment income. Now, interest income, if you have interest income, it means that you have received the interest income. Maybe we have invested somewhere, then you have received that amount. Also, when it comes to investment, so if you have invested somewhere, it means that when we invest, we receive income. That income was added in the income statement. Now, what do? We less it. So it was added. So we are supposed to less it. So it was added. We are supposed to less it. Now, profit on disposal of an asset. Now, when we sell any asset during the year, it means that we determine if we have determined that we have managed to get a profit. That profit, it is not necessarily to be part of your profit, because remember it is determined from the estimates, and those estimates mostly comes from the depreciation. Now that one is categorized as non-cash item. In that case, when you have a profit on disposal of an asset, it means it was added in our income statement. So we are supposed to less it. We can also have loss on disposal of an asset. Now, loss was treated as an expense. Commercial was deducted. Now, if it was deducted, we add it back. So we add it back. So those are some of the items which you can find. So you add it back. So when you add this item together, there are some item there, then you add them together. So Then we can do the working capital changes. Working capital changes. Working capital changes, and the first one is either we can have increase stroke decrease. So it can either be an increase or a decrease in inventory. Now, when you have an increase, we are supposed to deduct. So we have an increase, we deduct. When you have a decrease, we add. Then increase stroke decrease in receivables. Now, when you have an increase, it's either we less, then a decrease we add. So you check if you have an increase or a decrease. And then the last one, increase stroke decrease. Increase or stroke decrease in payables. It is either we have an increase or a decrease. So an increase we less, a decrease we add. Then when you get this item, we add them together. Then we can get the gross cash flow. Gross cash flows. So gross cash flows from operating activity. From operating activities. Then we less tax. And remember, this one requires a working for actually. So let me tell you, there's some item which requires workings. All these items requires working. You can say this one is working 3, working 4. All these in IV, working, so working 5. So easy to connect with the difference. So tax paid also requires a working. Interest paid. So that you can get net cash flow from operating activity. So I will not put interest in this part. So I will not put. So when you are less tax paid and less interest paid, it is fine. But for me, I will categorize interest paid as a financing activity. So me, Mr. Weka hapa. So, but with some other people put the interest paid here. Anyway, it is well and good. Because wakiweka hapa inamaanisha they have categorized it as an operating expense. But for me, I will categorize it as a financing activity because an interest relates to the loan. So loan is part of financing. So maybe interest, I will not put it here. So once we get this part, so this one we call it A. So you can call that A. Let me use a different pen. So I can call this one A. So that is from the cash flow from operating activity. Number 2, you can go to cash flow from investing activity. Cash flow from investing activity. Cash flows from investing activities. Cash flow from investing activities, na tunaweza sema we can have sales from proceeds of an asset. Sale proceeds from sale of an asset. So that's an income. So when you sell something, when you sell an asset, we expect to receive the amount. So that's an inflow. So we're supposed to add it. Purchase of non-current asset or the acquisition. You can use the word purchase. Other people use the acquisition. Acquisition of non-current asset. Now when we purchase something, we are repaying. So pesa inatoka. So to remove the amount inatoka. Investment income. So investment income stroke the interest income. Now in this case ni tofauti. Now we are receiving the amount, so we add it. So kumbuke hapa ni non-cash item. Remember hapa ni non-cash item. That's how you are deducting, because we treat it as a non-cash item. But in this case, when we receive that amount, we are supposed to add it back. Okay. Now when you add them together, so these are some of the items we can find. Unapata hapo. It can be a positive. So hizo kumbuke inaweza kuwa positive or negative depending with the question. So it can be a negative or a positive figure. So we shall get the net cash flows from investing activities. Hiyo hapo. We call it B. We just call it B. We call it B. Then tuende kwa the last one, cash flow from financing activity. Cash flows from financing activities. So cash flow from financing activities. So we can have issue of shares. So if issue of shares ni kumaanisha tumeissue shares, tuna receive amount. So tukiuza our shares, so tumeissue, so the people subscribe, wanatupatia pesa, so we add it back. So we are supposed to add issue of debenture. We add also issue of debenture. So issue of debenture we add. Loan borrowed. So we have loan borrowed. Loan borrowed. We add loan borrowed. Loan paid. Loan paid in a reduce our amount. Loan paid can reduce our amount. We can talk about the interest paid. Interest stroke dividend paid. So we can have either or both. So it is either we have both or one of them. So interest or the dividend paid. Then is all I think enough. So we can get the net cash flow. Net cash flows from financing activity. So it can be a positive figure or a negative figure, or it can be a negative or a positive figure. So that's why we call it C. It can be a positive or a negative figure. Now tukishafika hapo, now we can find the net changes. Net changes in cash and cash equivalent. So we say net changes in cash and cash equivalent. So hiyo ni A plus B plus C. Unapata figure hapo. It can be a negative figure or it can be a positive figure. So it can be a negative figure or a positive figure. Then we add a cash and cash equivalent at the beginning. Ukishapata hiyo, then what we shall get cash and cash equivalent at the end. cash equivalent at the end. So that's our format. So sijui kama nimetoka nje. I think that is okay. Bas. That's how you do that question. That's how you are supposed to do that question. You are supposed to use that format. The format in a hivyo. Now, but before we do our question, we need to show you how to do some working. So there are some workings which are very, very important for this question. So there's some very, very important items which you need to know how to prepare. Number one, you need to how to prepare the depreciation. So depreciation account. So depreciation. So this depreciation. So working number one. So you need how to prepare the depreciation. Now depreciation is prepared from the accumulated depreciation. So you need to open the accumulated depreciation. So automatically, so you need to open accumulated depreciation account. Depreciation account. So you need to open this account. So you start with the we start with the balance brought down for the accumulated depreciation. Then balance carried down. Then kuna some items which you need to put inside. For example, disposal accumulated depreciation. So if they disposed an asset, the accumulated depreciation of that asset is supposed to be debited in the accumulated depreciation account. So remember, when you are determining this depreciation, you start with the balance brought down of the depreciation, unamalizia balance carried down, then you put the amount of the depreciation, the accumulated depreciation. So accumulated depreciation of the disposal asset, or the asset being disposed. Now when you balance this account, the balancing figure becomes the depreciation, which is supposed to go to the income statement. So unaandika hapa depreciation. Remember, this is supposed to go to the income statement. That one. So that depreciation you're here. Now, you also need to know how to prepare the interest expense. You also need how to know. Okay, before we go to the interest expense, because we are talking about the depreciation, we can talk about how to determine sales. So because we're talking about the depreciation or the assets, so just talk about the assets. Now you need to know how to prepare to determine this one. Let's call it working six. Working six. Now for working six, you need to know how to prepare the sales proceed. So you need to know how to prepare the sales proceed. Nikifanya na tick. So how do you prepare the sales proceed? Now sales proceed. That is how you prepare the sales proceed. So you need to prepare disposal account. Disposal account. Disposal account. Then you need to prepare the disposal account. Then you start with the cost of the original asset which is being disposed. So your asset yenye wanauza, it had an original cost. So you need to put the original cost of that asset there. And then you put a gain. Any gain from that asset. So when you dispose, you get a gain. Unaweka on the debit side. If you get a loss, so a loss unaweka this side. A loss unaweka the other side. And then also you don't forget about the accumulated depreciation. Depreciation of that asset that is being disposed. So accumulated depreciation of that asset being disposed. Kumbuke? Being disposed. Kumbuke hii na hii ni same. So kumbuke hii accumulated depreciation na hii accumulated depreciation ni same. They are the same. They are the same. They are the same. So kumbuka accumulated depreciation, kumbuka ya disposal. Ama niandike the word disposal. 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 Accumulated depreciation. Itakuwa sawa. Now we can balance this figure, this account. You can balance this account. you get the sales proceed. So ukisha balance this account, you shall get the sales proceed. And hii hapa. Now in some situation watakupatia sales proceed, wakwambia you determine gain or loss. Now in that situation, ukumbuke also, remember we need to prepare either gain, this is the gain and this is the loss. Remember, so this the profit is the gain. So with the word profit, this one can also be the profit. Stroke profit. So this one is the profit from sale of an asset. Now this one is the loss from profit of an asset, and this hapa, you can see this hapa. So we have profit on disposal of an asset, and then you have loss on the disposal of an asset, Sometimes you can be required to prepare this to our item. Now in that situation, you need to remember, kama umepatiwa sales proceed na uko na accumulated depreciation na uko na cost, then ni kumaanisha what is missing is either this figure or this one. So you just balance. So utakuwa unafanya nini? Unaangalia the items available in your equation. So utafanya maswali yenye sometimes you don't require to prepare the sales process kwa sababu atakwambia they sold this asset at this amount. Some other question atakwambia there was a gain or a loss on that asset. So penye pale umekwambia you have a gain or a loss, you need to prepare this account to know the sales proceed. In the question where amekwambia they have the sales proceed was this and this, ni kumaanisha you need to determine either gain or loss. So you need to remember that one. You need to remember that one. Now that one is okay. So hii tumemaliza na hii. Now this one you don't need requires a working because hii kujua ni haraka. Interest expense tutafanya baadaye. Investment income hiyo unaangalia the difference between the carrying amount and the amount umeuza. That one is okay. Now another thing that we need to prepare here is the acquisition of the non-current assets. Acquisition of non-current assets. So this one you need to prepare the PPE account. PPE account. Property, plant and equipment. And remember it is prepared at cost. So remember it is prepared at cost. Remember it is prepared at cost. It is prepared at cost. So we say tunaanza na balance brought down. Balance brought down. Then you have the balance carried down. So balance brought down. So remember they are on cost. Balance carried down. Then the disposal cost. Disposal cost. Unaweka hapo. Now when we dispose an asset, remember if our balance tulikuwa na balance ya an asset side, then tukauza, ni kumaanisha if we sell any asset, our asset value, the number of assets will reduce, and therefore we credit the disposal cost on the other side. Then you can check if there is a revaluation gain or a revaluation. So revaluation gain. So when you have a revaluation gain, unaweka side B. Revaluation gain. Unaweka hapo. And then if you have a downward revaluation, unaweka your side. Now the balancing figure, now we find the balancing figure. The balancing figure will be the acquisition or the purchase. So itakuwa acquisition. So that's how you get it. So that will be the acquisition. So unaweka hapo. So that's how you get the cost. And remember, I want to let me go back to these items. Now remember, in depreciation. So NB, you need to know that one. All this working is applicable when the items are on cost. All these workings are applicable when the PPE is on cost. Now, ukiona PPE is not on cost but on net book value, then these workings is not applicable. So remember all this working tumefanya hapa, ukipata that your PPE, the values are written in net book value. And I'm repeating, if you find the the value of the assets, they are on net book value and not on cost. This working will not be applicable. Hii work tumefanya hapa zote, they are only applicable. They are only applicable when the PPE is on cost. They are only applicable when the PPE is on cost. When the PPE is on net book value, don't use this format. Utaanguka. Sawa. And in most cases, when the question is about net book value, mambo na cost hakuna. Hata hizo figures za cost in most cases utapata haziko. Now we can also learn how to determine other accounts. We can learn to determine other accounts. Okay. Now, how do we get accumulated depreciation actually? Now, we remember net book value. You need to know this formula is equals to cost minus accumulated depreciation. So kumaanisha accumulated depreciation is equals to cost minus net book value. So that's how you get the accumulated depreciation. That is how you get the accumulated depreciation. Now, there's another working that we need to know. We need to know how to prepare. Number one is the tax paid. Tax paid. So tax paid requires a working. Whether you like it or not, you need to prepare the tax account. Whether you like it or not, you need to prepare the tax account. Now, how do you prepare the tax account? Just prepare it. Tax account. So we start with the balance, brought down, then balance, carry down. Now ukiwa na tax zote mbili, we have the deferred and the other one. Unaweka zote tu hapo. Balance zote, hata unaweza ziamua kuzi add zote. Unaweka hapo na side. You can add all those value of tax. Then what is in the income statement? Ndio unakuja unaweka hapa. So income statement. So I will just call it income statement. Income statement. So ukumbuke nimepata pale kwa income statement, it is not what is paid. I want you to know that. What is the income statement? It is not what is paid. So ukitumia hiyo hapa, where is it? Ukitumia that figure hapa, kitakulamba. Now, what is the income statement? Unakuja unaweka hapo direct. It is not paid. Then you get what is paid. So unakuja andika hapa. Balancing figure would be the tax paid. Tax paid. Tax paid. So that's how you get the tax paid. Na unakuja kuweka wapi? Hapa. Another working that we need is the interest paid and the dividend paid. So interest paid and the dividend paid. So we have interest paid and the dividend paid. Interest paid and the dividend paid. Interest paid and the dividend. I think that is the last working that we want. So you can say interest paid. Tunaanza na interest paid. So tunasema balance brought down, then balance carry down, then income statement, naweka hapo, then unakuja andika hapa interest paid. Paid in his interest account. This is supposed to be interest paid. Supposed to be the interest paid. That's what we want. Same applies to the dividend. 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 Same applies to the dividends. Same applied to the dividends. Now, I think that is all about it. That's all about it. Anyway, there's the one for the dividends so that you just don't forget. dividend account, balance brought down. Then you have the balance carried down. Then you have the income statement. Income statement. Then we balance the account. So we balance the account. So the balancing figure itakuwa on this side, so unasema dividend paid. Dividend paid. So that's all that we need when it comes to the preparation. When it comes to the preparation of the final account, sorry, when it comes to the preparation of what we call the cash flow statement. So when you call cash flow statement. So that's all about it. For this will be the lesson 1 for this class. So we shall go to lesson 2 in our next class.